First idea, Richelieu Hardware, known for kitchen cabinets.
Yes, exactly. So this is a high-quality company, and they import and distribute components for kitchen cabinets, things such as hinges, knobs, and different various pieces that go into the components of them. During COVID lockdown, travel was not permitted, and so all of us were kind of stuck at home, and some of us had extra discretionary income from the CERB payments, and since you couldn't travel, you couldn't fly off somewhere, what would you do? You would renovate your house. And so if you renovate your house, where would you tend to renovate? You tend to renovate either the bathroom or the kitchen. And so what happened is during COVID, Richelieu really benefited from this renovation cycle increasing. So their earnings per share moved up considerably, and that drove their stock price up. Now that we've come out of COVID, for the most part anyway, what we're seeing is that people are starting to travel, and they're spending that discretionary income. They are not renovating their homes. They're not doing any changes to their bathroom or kitchens. So as a result of that, earnings have declined for Richelieu. And so along with the decline in earnings, we see softness in the share price. And so this presents a buying opportunity. Now, you might have to be a medium-term investor to think about that, because I don't see a catalyst immediately. But I think that if you're patient, this is a very high-quality company. You can buy it here. The management, Richard Lord, the CEO, he owns a considerable amount of shares. And so I like that because it ties his interest with that of the minority shareholders as well. So it's a good opportunity to buy it here. It pays a little dividend and wait for that stock price to appreciate.
BCE is your next idea.
Yeah, exactly. So BCE is a household name across Canada. It provides cable, internet, wireless, and wireline phone communications. They own some sports teams as well, and they produce content, obviously. Shares of BCE have traded down, not so much due to the fundamentals of the company itself, but more due to the fact that interest rates are simply rising. And this is a widely owned company across Canada and even outside of Canada. And so basically, shares will trade down as people are reducing their exposure to equities. But it's a great recurring revenue business. It's a very stable, well-run company. It's a blue-chip company, and it pays a dividend yield that's close to 6%. And it's not very often that you can buy a big blue-chip company like BCE and buy it at a dividend yield close to 6%. So we like it here. You're going to get some capital appreciation as well, and you can sleep at night with this one and hold it for a long time.
Okay, and BCE, of course, the parent of BNN Bloomberg. Your final idea here is Bank of Nova Scotia, a bank stock that has lagged.
Yes, exactly, Andy. And so this is part of the reason why we want to talk about it today. So this is a bit of what we call a reversion to the mean trade. So this bank has lagged the other banks in Canada, but yet it is a very good bank. So it's one of our big six banks. What's notable about Bank of Nova Scotia is that 45% of the revenues is from Latin America. No other Canadian bank can give you that kind of foreign exposure to that region of the world. And generally speaking, that region of the world and the developing markets are growing faster than what we grow here in the developed markets. And so the idea is that by having exposure to Bank of Nova Scotia, those markets should grow quicker and earnings should grow quicker. That being said, that hasn't been happening. There's been softness in those markets, and so Bank of Nova Scotia has underperformed. We also know that there's going to be a change in their CEO. So a new CEO is coming in. He's coming from outside the banking industry. This is Scott Thompson from Finning. So this will be interesting to see how this takes place. He's been on the board of directors there since 2016. But we think that he will come in and there will be new opportunities for growth going forward for the company. They may try to do things a little bit differently than what they've done in the past, and we like that. The company also pays a nice, juicy dividend yield of 6%, so you can enjoy that big dividend yield, and you can pick it up, the company up at a single-digit PE multiple. So it's very attractive here, both on a yield basis, but then also on a valuation basis.
And you say this is a reversion to the mean opportunity.
Yes, exactly. So basically what I meant by that is the fact that Bank of Nova Scotia has been underperforming, and we're not looking for it to necessarily grow to new highs or do something it's never done before. We simply want it to basically play a bit of catch-up to the rest of the Canadian banks. And we think that there's the opportunity to do that. It's a very good bank, it's very well run, and they've got some smart people there.
Okay.